Today's episode of Stablepilled is brought to you by Limited, the global business banking platform built for founders in the US, LATAM, and APAC who operate across borders. Limited makes international scale seamless. You can open a US bank account for the US or non-US entities and accept funds locally with accounts in the EU, Mexico, Brazil, and the UAE. They support cross-border payouts in over 80 currencies across 300 local payment methods, and your team gets premium Visa cards shipped globally that can be used anywhere. I've actually been trying them out so far, and I found their method for converting between fiat and crypto very easy. I was just in Mexico City recently using them, and I can tell you that is not the case for many products. So stop letting legacy banking slow down your growth. Go to limitedapp.com and unlock borderless banking today. All right, welcome to another episode of Stablepilled. We got Henry Hecht-Felella, VP of Crypto at SVB. How are you doing?
Good. Thanks for taking the time and having me on. I'm excited to be here.
Yeah, it's really exciting to talk to you. I got to meet you at Crypto Peaks this year, and I was just always really impressed with your knowledge and expertise in the space. Been a founder, been helping out on the institutional side. Why don't you give me a little intro about yourself?
Yeah, of course. The gray hairs and wrinkles on my face kind of speak for itself in terms of duration of being around. But yeah, started off in the space in 2017. I worked with a company that was selling structured products to family offices, really kind of thinking about the thesis of uncorrelated markets to the S&P and tech indices at the time. Obviously, that's a little bit more correlated now. And then from there, moved into consulting, was at Strategy and PwC for a bit, helping on the organizational strategy side with the focus on digital assets. And then one of my last clients at PwC was actually Polygon Labs, which is how I ended up back in the space full time. Got poached by Polygon Labs to run operations. Spent about 2.5 years there running ops from the kind of full stack of things. So that started off in just business operations and then bled into everything from the BD side to marketing and helping kind of structure what initiatives were. I joined Polygon right after the $450 million raise from Sequoia. And then by the time that I left, the team was slightly smaller and more focused, and we're kind of starting to play out the thesis on payments. I, at the time, was really kind of keen to explore the app layer of protocols, and which we can get into a little bit later, but I kind of thought the protocol space itself and block space was commoditized and not necessarily needed to be continue to be developed. So it was really keen to explore how we could onboard new users, how we could start using some of that block space, how we could kind of create new innovative technologies from a user experience perspective. So started my own company called Loot Labs, which was focused on creating a Telegram native product studio. So how do you build single use case products on Telegram that already has a captured audience and kind of engage some of these early tech adopters and really teach them what the inner workings of digital assets companies are like and what some of the key advantages were. We raised about $1 million and we're off to the races and we're excited about the development. And then my co-founder and I unfortunately had a falling out, which led me to step away. If you are a founder, you have experienced having a co-founder dispute and kind of walking away. I feel like most good founders have a couple of those stories.
I have a couple. Yep, I do.
It's traumatizing at the time, but looking back, it's a great learning lesson. And kind of, everybody jokes about being a startup founder as B school and teaches you all the lessons from the legal side all the way through to some of the more emotional side of it. And then after that was kind of thinking about what I wanted to do next and really enjoyed being early stage, really enjoyed being in the founding seat. So found a company called T1 Protocol, which was focused on real-time proving, trying to solve a little bit of the liquidity fragmentation across EVM chains, which after building on the app layer was like very clearly an issue and something that wasn't solved for, and kind of the last piece of infra that I thought was really interesting, and honestly I still think is pretty interesting, and now we're starting to see some of these clearing houses pop up, which is solving some of the liquidity fragmentation, but at a different level. So joined them as founding operator. I was the only non-technical hire on the team. Really enjoyed my time there. They were building something interesting, and they had really, really great tech talent. And then come September, CEO and I sat down and kind of had a conversation around what burn rate looked like, what the fundraising environment looked like, whether or not it made sense for me to stay on the team, and decided that it probably didn't, and for us to part ways. So ended up stepping away and still supported the team in an advisor capacity, still very close with the team there as they continue to develop and try to help whenever I can. But after 2 swings at bat in somewhat of founding seats, felt a little bit of the burn for sure, and wanted to be able to work with these early stage companies without necessarily being a part of the founding team. And that's how I found my way to SVB, and or FCIB now, First Citizens Innovation Banking. So joined SVB to really help early stage founders. I'm part of the digital assets team on the commercial banking side. We can get into a little bit more about what that means. But I manage our early stage companies nationally, so that's pre-seed, seed stage nationally. Our emerging managers, so that's sub $200 million of AUM VCs that focus on digital assets, and then growth over on the West Coast. So growth really just means anything above Series A on the West Coast, and then we have a team that manages Series A plus on the East Coast as well.
Cool. Well, thanks for the great introduction. Kind of few questions that come to mind for me about what you said, which is, First Citizens Innovation Bank is what I should be calling you guys?
Yeah, FCIB. That is the official brand that will transition away from SVB in November. So we made that announcement a couple months ago, and post the acquisition of SVB post 2023, which we can talk about. I'm sure everybody has a lot of questions about that. We are now stepping away from the SVB brand, but still really focused on the same core offerings, same core capabilities, and honestly, even more so now than anything, we really think that the early stage founders are where we want to continue to focus in order to win the business long term.
Nice. Yeah, that makes total sense. I think after the crash and everything, it's a good time to think about rebranding. And then what's the vision for crypto at First Citizens Innovation Lab? FCB.
Yeah. You can still call us SVB. It's fine. As long as we have the premise of the fact that it's slowly changing. I still stumble occasionally and call us SVB as well. And
this will be like a Twitter X or a Meta Facebook situation.
Listen, I still call it Twitter, so I still call it Facebook and Twitter, to be fair. Maybe that's the boomer in me, but So when we think about the focus of digital assets at FCIB. The core starts with the fact that back in 2022, 23, pre and post bank collapse, we were really focused on the idea of innovation economy, right? And we always kind of have been. And one of those key signals in the innovation economy for us was digital asset companies and providing those founders with a reliable place to bank. I think most people in non-founding seats take advantage or don't necessarily think about how important it is for a company to have a core banking partner that actually supports them in every kind of transaction that they want to make, but more importantly, just making sure it's reliable and not ending up debanked. So we obviously saw a lot of that in some of our competitors in the 2023-2024 timeframe. So when we think about the core of our offering, it really starts with reliable banking, and then it also starts with people who know the space well, right? So I obviously came from the digital asset space. I would kind of joke that I'm a banker in disguise, and the fact that I'm barely a banker and mostly just focused on working with these cool founders that are doing interesting things. But we also have more folks on our team that also came from the industry. So my counterpart in New York, Verena, came from the industry and came from the banking side. Anthony as well has been with the bank for 10 years, but has really always focused on the crypto side. And we also have an entire compliance team that understands the space really well. Favorite kind of anecdote from that is one of our heads of compliance actually has most of his house mortgaged on chain and has ETH as collateral. So hopefully it doesn't get liquidated. I always joke with him about that. But so it's a team that really understands the space deeply, and that's kind of where we start with our offerings. And then when we start thinking about what happens outside of just commercial banking capabilities and fiat, we really start with the founders first approach, right? What do these founders need? What kind of products can we offer that actually make a difference in these founders' lives and are not just buzzwords? And I think that what that starts with is thinking about things like, how do you see everything as one balance, right? and continuing to extrapolate from there of what additional products are needed in order for everything to be one balance, right? You can kind of think about what that might mean, and I can't talk about anything too publicly, but really our focus is how do we create as seamless of a product as possible for these founders who focus on digital assets companies.
Okay. Yeah, until the last little bit, I was like, okay, so very simple vision. Continue focusing on founders in this vertical. Sounds like you have some ambitious things coming that you can't discuss, so I won't pry into those yet. We'll have to bring you back.
It sounds like we have another pod lined up post release.
Yeah, you and I both know there's a second secret topic we want to talk about in the pod too. Okay, but you have a hot take for me. You had before this conversation, we were talking about things we discussed, and you had what I thought was a really good thing. So you want to kind of launch into that? I think that'd be great to talk about.
Yeah, I'm happy to. I always love a good controversial take. What else are good conversations? Most moderators and panels hate me for it. But so, it's interesting watching the space mature. As somebody who's had the majority of my net worth sitting on chain pretty much my entire career, it's been interesting to watch these different products come up and different offerings. So as I said, I was at Polygon after being a consultant and really saw the protocol layer kind of thrive there, right? So it was post a lot of the massive investments that were happening. It was post kind of this idea of the fact that on-chain was this weird, ambiguous thing, and a lot of these companies were diving in. And I think in that we created a little bit of a maybe inverse incentive model for some of these protocol founders, where the more buzzwords that they came out with, the more buzzy announcements that were released, token price was impacted, right? And I think most people at this point can kind of correlate token price with being the product back then. I think most founders were focused on that, and I think Polygon was good about the fact that it wasn't all just token price, but there was obviously a component of that as well. So what I think is interesting there is 2021, 2022, kind of 2023 all blended together in this idea of how do we create more block space? How do we create more availability for new kinds of products to be on chain? How do we attract the right founders for all of these different protocols to build the right products? And we kind of saw the fact that block space wasn't necessarily the restriction, right? Yeah, it wasn't something that we needed more and more of, and TPS even is not something that was necessarily a restricting factor. It was more so how do we get to a place that is different from the current products that exist without being on chain, right? And I don't think we were really thinking about new innovative ways to solve problems. Instead, we were kind of thinking about, okay, let's take existing products, let's put them on chain, and let's hope that solves our problems. Now there are probably, a handful of protocols that still have real builders on them that are working towards interesting things. And Polygon's a perfect example of a company that's pivoted into payments. And I think that brings us to kind of my hot take. I think a lot of what we saw in those early days of protocols in terms of trying to innovate and create more block space, we're seeing a repeated pattern now across the payment side. So almost every protocol is now focused on payments. They're saying, okay, great, we're going to go win this deal or that deal with these different companies. And I think we're seeing a lot of that same infrastructure build happen and kind of repeating the same process of let's build more protocols, let's build more block space, and now we're saying let's build more protocols, let's build more capacity for payments, let's build more protocols that payments can actually run on. And I don't necessarily think it's as restrictive as people are kind of associating things with, I guess is maybe the best word to say, as it once was, right? I think now we can kind of say, okay, we have payments providers, we have the core infra that payments are needed, and now instead of trying to build more infra for the payment side, we should go and say, okay, how do we actually build applications and how do we inject the protocols or the payment infrastructure into the applications that exist today to make them better? And our focus should pivot away from how do we just build more infrastructure into how do we build infrastructure that actually enables new use cases and enables something and adds benefit outside of what payment infrastructure exists today. Everybody's focused on cross-border payments and cross-border remittance, and I think that's interesting and important, but that's something that blockchain by itself solves. So how do we go one step deeper and create something that people actually want to use?
Nice. So you're basically saying past cycle, we overbuilt block space, suffered from that. This time we're overbuilding payments infrastructure, and we are or might suffer from that?
I think we're starting to see some of the early innings of suffering from that. And we're starting to see some of the some of the mega funding rounds, kind of similar to the Polygon raise in 2022 around payments infrastructure. And I don't know if we've really seen fundamental changes in how these payment companies are actually functioning that justify some of these funding rounds.
Yeah. Yeah, there's certainly been some stablecoin or payments focused protocols and blockchains I can think of now that launched 6 to 12 months ago and are not doing very well.
Yeah, and I think there's some exceptions to that rule, but some of the non-exceptions to that rule are kind of showing the early innings of what happened post all of these massive fundraisers for the protocol layer.
Got it. Yeah. So, okay, let's just play devil's advocate for 1 second. Check out your take here. So two differences. One, they don't have the token incentive, right? These companies aren't all, I mean, some are, but a lot fewer are launching tokens when they do this, right? Compared to the protocol. So there's like a little bit less of that perverse incentive to just make money quickly that tokens created, especially with the funding rounds and all that stuff. And then secondly, there is more regulated needs around payments. Payments have more regulations than block space has. They need certain licenses, certain blah, blah, blah. And so how do you kind of see that this is going to just be repeating itself versus have some key differences?
Yeah, you're asking the good questions. I love this. So I think, to your point, there's regulation that's required. But something that I said on a panel during consensus is I don't think we're actually building the technology for regulation. And what I mean by that is you don't see anybody who's focused on, let's actually take a step back. So banks, right? Myself included, SVB included, JPM, all of these folks have to report to regulators. And when we report to regulators, we have very standard ways of doing it. And we have reports that are accepted and reports that are not accepted because they're not in their standard format, right? Similar to any other thing in terms of anything that deals with government or federal agencies. And something that I think is really interesting is despite the fact that these protocol companies now, or payment companies, if we want to call them that, are focused on building compliant infrastructure for the current regulatory environment, nobody has built the infrastructure that actually spits out the same kinds of reporting that federal agencies can accept from a bank. So instead of going down the path of saying, okay, we need all this different infrastructure in order to support it, I actually think somebody should be building the equivalent of a Chainalysis reporting tool for payments. Because Chainalysis is already something that we accept, right? And federal agencies have accepted, and regulators have accepted, and banks are using. So if we can take those and say, okay, great, we have an understanding of what's accepted for on-chain infrastructure, what's accepted for on-chain compliance, what's accepted for off-chain compliance in terms of payments, we should actually take that and marry it up with the protocols and the infrastructure that's being built and say, okay, spitting out of these protocols, spitting out of these payment infrastructure layers, here's what the reporting is actually going to look like. And I think once we solve the reporting need on the compliance side is when we potentially see a massive unlock and we see standardization, right? So I think whether it's TRM, whether it's Chainalysis, or it's Alluvial or whoever else, it creates that reporting and creates that mechanism. That's like the really big winning use case.
I see. All right. Well, you kind of went from hot takes into like real use cases, so
it's a little less fun. I can go back to hot takes.
Well, I don't know. I'm like torn between going into the use case or like getting there in a little bit and finishing off the hot take thought, which I think that's what I prefer to do. If you're open to that,
yeah.
Let's talk about reporting in a second. But I think when I hear you say the reporting part and how it connects to the hot take is this idea that people aren't building what's really needed. They're building something that's not needed. And how I relate that to this idea of not having a token or perverse incentives and the idea that like there's more regulation. I guess the regulation is kind of the bridge. But it just seems to me like what should people be doing differently? Like and sometimes in crypto, there's not enough exciting things in these bear markets for everyone to go chase a billion things. And so like going after the big obvious thing does seem like a natural tendency. And if you already have funding or exist or you want to raise money, it seems like a reasonable methodology.
Man, I have so many takes here. Okay, so let me start. That was good. That was a good leading question. Let me start with the token incentive and kind of perverse incentives is maybe the best way to put it. So 2022 showed us that token go up only works for so long. And I think the thing that we missed or fundamentally didn't draw a line to because of what the regulatory environment was telling us at that time is tokens are really just a representation of equity. And I don't think that...
Not legal advice.
Not legal advice, but the reality is they are, right? And
that's what people mimetically want, right? Yeah.
Well, and that's like you're buying... Let's look at hype, right? And maybe this is the perfect example is people are buying the hype token not because of the tokenomics or the actual protocol, but because of the activity that's happening on the protocol and the revenue that's being generated via that activity, and then the buy and burn mechanism that's baked into the tokenomics itself, right? They're not going and saying, oh, I want ownership in this network, like what we tried to pitch in 2022. They're saying, I want exposure to the upside. They're saying, I want exposure to the activity. And to me, that's no different than buying a early share of a company, whether it's private or public, or it's going and buying Apple and saying, "Hey, I want a chunk of whatever I think you're going to do in the long tail future." So to me, it's if you draw that that line of connective tissue between the hype tokenomics and I'm just using hype because I think it's the most popular token at the moment is maybe the best way to put it, and the most popular model of this buy and burn mechanism, or using revenue, whether it's burn or not, to buy back your token is maybe the better way to put it, because the hype, I guess, technically isn't being burned. But I think it relates back to the same problem of, yeah, you can launch a token and maybe that creates false incentives for a founder to then say, okay, I'm going to launch and I'm going to go to bat with all of these partnerships and I'm going to try to make my token price go up. It's not really all that different than where we're at today, which is, okay, I want to go and raise a $200 million funding round for my Series A, so I'm going to go out and get a bunch of these logos, right? So instead of it being a public market tool like a token was, I'm trying to use cagey words to make sure I don't just slap myself in the face with regulation or with compliance issues, and I don't get yelled at by my legal department. But I think it's not all that different, and some of these founders are exiting on secondaries. And listen, I don't actually have anything wrong with a Series A founder taking a little bit of money off the table, but if that's the case, then these people are incentivized to go out and get these big logos and go raise massive amounts of money and go raise big funding rounds so that they can take money off the table. And instead of doing it in a public market and giving people upside potentially, they're just doing it in private markets instead.
Yeah. So token or not, people are going to find ways to make money quickly.
Exactly. And then I think the other kind of piece where I was going with that in terms of hot take is you mentioned it's the easiest for somebody to go out and found a company that's in the hot buzzy words that VCs are funding at the moment. And I apologize in advance to all of my VC friends, but I think you're correlating VC funding with the smartest folks in the room and I don't necessarily think that all VCs are not the smartest people in the room, but I think a lot of people are following narratives, and if they don't have exposure to a certain sector, they're trying to get it by creating a company, right? Or saying, hey, I'm going to fund this company if you go out and create this thing to early stage founders. And that doesn't necessarily correlate to the fact that it's the best thing to be created. I actually think most companies that are the most successful and that are the most interesting are likely not the ones that are going out and raising these massive rounds. I think like you're going to look at early tech days, right? Like Facebook is a great example, or Meta. They struggled to raise their initial rounds. They were the most innovative platform. Some of these other folks who struggle to raise big rounds trying to do innovative things in the digital asset side, I would correlate very similarly. So I don't necessarily think that the best companies come out of the things that are funded the most. I think instead it's actually probably the opposite, and the best companies come out of the things that are probably funded the least.
Okay. Yeah. Well, you kind of lost me on the Facebook part because I feel like I just have that image from The Social Network in my mind of Mark in pajamas going to Sand Hill, which is kind of saying the opposite, that it was easy for him to raise money. But I think your point still stands that like there are companies that are unpopular and become really big over time. And that's sort of what people, you're saying that's where smarter money is going. They're not just chasing every single stablecoin round.
Yeah, they're not chasing every single stablecoin orchestration company. Let's put it that way.
Yeah, yeah. Okay, so that makes sense. There's one area though that I do think is like I don't understand fully, and so I just the counterpoint to that, I think sometimes I've heard Mark Andreessen say something like sometimes it's just obvious. There's not You don't have to overthink it. And so the one area I'm curious to talk about is less directly on payments infrastructure, but more about the kind of newer wave of companies that have been coming out more often these days, like a Better Money company, for example, that's in the treasury management side. So do you have like opinions on where the treasury management fits into these kind of trends? Is it the same problem where people are overdoing it? Is it important and needed? Like, how do you think about that part of it versus the payments itself?
Yeah, I think one thing I would just want to like make sure is not lost in translation here is I think competition is healthy, right? And competition breeds the best companies. So does that mean that I think we need 1,000 different protocol layers? No. Or I guess like hundreds of thousands, honestly. No. But do I think that having a subset of 100 very, very strong protocol founders is important? Yeah, because that creates the incentive for these founders to go out and win, right? And it creates the pressure around them. So, and obviously that can be kind of applied at any scale, right? So whether it's 100,000 protocol companies and 1,000 is good for whatever it might be. I don't have a specific number. But I think that is similar to what's happening in, let's call it treasury management or some of these stablecoin orchestration or
Settlement.
yeah, or settlement layers. Maybe that's the best way to put it. Is we're seeing this compression happen, right? So I think everybody's kind of aligned on the fact that on-chain fees have to compress in order for us to get to a place where, let's use the hottest buzzy topic, agentic payments are a real thing, and we can do micropayments, and it's not going to break somebody's pocket in order to do hundreds of thousands, millions of micropayments at a time. And I think the only way to get there is to have liquidity fragmentation be solved. And that, I think, was an important distinction and an important point for me to join T1 when I joined them post being a founder is I do think that is still something that's broken, right? Is this idea of liquidity sits across all of these different chains. I'm a user. I don't want to go and connect a wallet that then is attached to EVM or attached to SVM or whatever it might be and use a different network. I just want to be able to spin up a wallet and have one thing. And the only way to do that is to create either a bridge and have it be kind of a robust layer similar to, we were talking about the LiFi guys earlier, the LeFi guys, like they're doing it on chain, but I think it's even actually more important to think about what does it look like to do that off chain so that we can compress the fees even more. And the Better Money company is doing that, and some of these other stablecoin settlement layers or what I would call like clearinghouse layers are doing it. And I think that's a really interesting topic. And I actually think like when I thought about what I was going to do post T1, one of the things I thought about was do I go out and build a company that focuses on settlement, that focuses on kind of institutional grade liquidity is maybe the best way to put it, so that these folks can do it. So that these folks who are building these app layers or these different companies can come in and use APIs to actually route into it. So when I look at the space, I think that that's still something that needs to be solved. And I actually don't think that that's a super overcrowded funding environment at the moment. So like I think the fact that the Better Money company only raised $10 million, despite being a previous A16Z partner and kind of having a lot of these backers and having a lot of this experience of saying, okay, I'm going to go fix this individual problem. The fact they only raised 10 million, they didn't raise 50 million for a seed or $100 million for a pre-seed or whatever they wanted to call the round, tells me that that's still not a overcrowded space to play in.
Okay. Well, thank you for righting the wrong. I falsely accused a space in your mind. I have an ignorant question and very selfish one. So to me, I understand this need for clearing and settlement and liquidity, especially liquidity being on chain for so long. But some of the other parts, I'm like, how is this a VC scale business? Can you tell me a little bit about like how, when you were thinking about doing it, or these companies you see, where you see like they could actually become worth $1 billion. They could become worth 10 billion. To me, it's like, okay, it makes sense to make money move around faster, but how hard is that?
Yeah, I think the answer to that question is drawing similarities to clearinghouses in like public companies today or public markets today, right? So New York Stock Exchange, good example, obviously, that's the one that everybody draws a connective tissue to. But even if you think about some of the companies that were acquired by the S&P, right, and have kind of built these rails for what is TradFi today. These companies were acquired for billions and billions of dollars. One of my very close friends was his parents' company was acquired for a lot of money by the S&P many years ago, and that tells me that there's still avenues and routes for new infrastructure to be acquired by some of these larger players. And I think that's the VC scalable outcome, right? It's not necessarily, okay, I'm going to own all of the transaction volume or I'm going to replace the New York Stock Exchange, but it's, I might get acquired by the New York Stock Exchange for $5 billion because I'm doing so much volume, and I've created a new tool that if they routed all of the settlement that happens on public equities through me, they would save billions and billions of dollars every week, every month, whatever it might be, and therefore the outcome is actually worth it.
Got it. So it's almost like they can get big, but they can never, or they couldn't easily go public. Like they're much more acquisition focused, probably. Yeah.
Yeah, I actually think that that's a really good connective tissue to draw in terms of what I think is potentially wrong with the space, is I don't think enough people are focused on the acquisition targets. I think everybody is focused on going public or launching a token or whatever it might be, but people aren't necessarily focused on building the infrastructure for existing systems today. And instead they say, oh, I want to replace the entire existing system.
Well, VCs aren't historically known for encouraging acquisition. That's sort of a net bad thing for an outcome. Yeah.
Yeah, which is funny because if you're a pre-seed, if you're a company that's raising a pre-seed, you have VC backers and you draw a very clear line of how you think you're going to get acquired for $2 billion in 5 years from now, that's a great outcome. That's better outcome than most of the tokens that get launched. So yeah, I don't know. It's a little bit nuanced for me to think about it that way. As somebody who's written many angel checks on kind of my own portfolio, if somebody came to me and said, hey, I have a very clear path to acquisition in, let's call it 5 years, that's a founder that I'd be willing to bet on, because I think they're being realistic instead of saying, oh, I'm going to replace the entire system and go public or launch a token.
Nice. Well, I guess, what do I think about your hot take overall? I think it makes sense. I think it's kind of outside of crypto. You can make a similar hot take that there are cycles and people overcrowd cycles and it gets overfunded and it crashes. Crypto is a weird dynamic where there's these 4-year cycles, and for 2 of those 4 years, it's all you can do is kind of build quietly. You don't try and sell anything really. So it's pretty different. But yeah, I think that's a reasonable take, and certainly nice, refreshing to hear after you just hear person after person talk about how they need 50 states of, regulated payments infrastructure, and every chain is chasing, kind of doing very similar stuff. It does make you hope man, let's just have 1 or 2 or 3 of these. I always think 3 is a great number personally, but anyway, this isn't about me. This is about you.
Yeah. I think your point actually is really interesting, and something that I've learned over the course of the last year being at SVB is payment infrastructure. A lot of payment infrastructure exists today, right? And we have things like what you call it as an FBO account, right, for transactional activity, for different banking clients that are sponsored models, right? So these clients in traditional fintech rails don't necessarily have to go out and get licensing across all 50 states for MTLs. Instead, they go out and say, okay, I'm going to use a sponsored account for a bank, and then I'm going to go out and do all the marketing, right? So they don't necessarily have all the infrastructure rails. And I think that's a really important distinction of where the crypto space might be able to look and lean more heavily into TradFi rails that exist today already and some of the services that exist today, versus saying, oh, I need to create everything as net new. And I think that goes back to one of the big theses I had when I founded my first company, which is the fact that distribution is the moat. And I think fintech players have evaluated that and kind of realized that, and that's why a lot of them go to banks to get FBO accounts and then focus on the marketing and distribution. I think crypto companies could potentially take a page from some of those playbooks of the fintech companies, maybe the best way to put it.
Yeah, that makes sense. Okay, well, thanks for going through the hot take. I think there was a couple of tidbits we did talk about picking up on. So let's say there's a lot of founders and investors usually listening to these shows. Let's say I'm a founder listening to this episode. Give me your pitch. Like, what's the company I should build on this like reporting regulation thing, or do you don't think that's possible at a startup level?
Man, you're asking me a good question. Damn, I wish you would have given me time to prep about this one. No, I'm joking. But this is, I guess, for all of the audience, this is just like completely non-thought about is maybe the best way, aside from just thinking about the market overall. One of the best ways to think about it is go to a bank, ask them what's broken, ask them what is preventing them from incorporating or wiring up, maybe is a better way to put it, all of these different services that already exist today. And then find your moat, find the thing that you can build around it. And I think something that we don't do enough of is what you would call like customer interviews in traditional technology or fintech companies. And I think one way to do that is to go to a bank and say, hey, what's broken? What do you actually need me to fix? And build around that. I mean, I get pitched transparently all the time by all of these different companies that are focused on all of these different things that are trying to kind of build the same thing that we already have that we don't necessarily need. And they're just trying to add a different layer into the ecosystem that exists already. And I think one of the more interesting ways to do that is to say what's actually broken and preventing you from wiring in all of these different service providers that already exist.
That's a great take, and you've done, without preparation, you've done a good enough job that I have to turn it back around you and say, you are a bank. What are your problems for doing this?
Oh man. Well, I'm glad I did a decent job at that. Yeah, I think so. I think reporting is one of them. So you say, okay, I have a let's call it a yield company, right? If you're working with a bank that has a custody product, and you say, okay, I'm going to go and offer them yield, and it's going to be a regulated yield environment, and people are going to be able to reliably audit the vault or reliably audit the stablecoin, whatever it might be. What's the thing that's missing there from allowing somebody to, like a bank, to actually wire it in to their system? And I think the answer is probably the actual connective tissue, right? So let's talk about legacy banking rails, right? Some of these systems were built in the 1950s, 1960s, 1970s. You go to most of these banks and you look at what their back-end infrastructure looks like, and it's green text on a black screen. So if you say, okay, great, now I understand that the new technology exists, I understand what the old systems look like. I think most people aren't focused on the connective tissue between those two, right? How do you actually plug one thing into another to make it work seamlessly? So I would go and if I was a founder right now, I would probably build that connective tissue, and I would think about it from a perspective of TradFi fiat rails, banking systems, and ledgers that exist today versus the new wave of technology is maybe the better way to put it. New wave of assets, new wave of yield that's coming into the market through digital assets, and say, okay, how do I actually incorporate these two things together so that we have real connective tissue and a system that works without it breaking on a continuous basis.
Cool. Yeah, makes sense. All right. Well, founders
I don't know
out
how to
there.
build that, but that's what my answer is to any founder: is go figure out how to build that problem,
Yeah,
or how to
founders out
go
there.
figure out how to solve that problem. Is maybe a better way to put it.
We've had other founders pitch some other fun ideas, so it's always cool like hearing kind of people who are building and in the space and getting bigger, what their real problems are. Thanks for sharing that. Okay, what else we talk about discussing? One question I'm curious about that's kind of been asked of me or I've thought about a lot is, and I don't know, you might not know much about this or have a lot of opinions, so we can pass on this one, but Clarity Act getting passed this year or not?
Man, this might be something that I have to punt on from a compliance standpoint more than anything else.
Oh, okay. Yeah, no worries.
No,
That's fine. Yeah.
here's my opinion. I think we have, and this is me speaking on behalf of myself and not representing any of the banks or financial institutions. We have connected a lot of weight to the Clarity Act being passed in order for us to get to a point where we think banks are comfortable with using these products. I think the real answer is back to my point around what founders should be focused on. The passing of that legislation just gets us to a point where banks can actually enable it. But then we still have 3 years probably of building in order for us to get to a point where banks are able to use the technology. So whether that the Clarity Act passes today or passes this year or passes next year, I still think we're probably, let's call it 3 years behind of being able to actually implement a lot of this technology, even if it does pass.
And what's the 3 year lag? Like where are some of the big chunks of it?
Yeah, I mean, this is just like anecdotally 3 years of how long I know it takes for big banks to roll out products now. Granted, it brings me to banging my head against a wall occasionally because I'm used to this founder and startup life of not really caring about, the potential limitations of a regulatory environment. But I think the lag is, let's say Clarity passes tomorrow and everybody says, okay, great, now we're allowed to use this. Great, but I still need to get from fiat in my commercial banking account to stablecoins, to yield products, to having, and those yield products need to be regulated environments. They need to be audited. They need to be, there needs to be ratings that are attached to it, right? That say, okay, this is a yield that's worthwhile on the risk. And we have obviously that on the debt side. When we think about what different debt products look like and different ratings for bonds, and we've kind of established a lot of that market, but we have none of that infrastructure and none of that rating, or none of those ratings, and none of the actual environment that people might be comfortable with depositing funds into in the on-chain environment. So I still think that even if it passes today or tomorrow, we have another multiple years of developing the right technology in order to actually get us to a point where people are comfortable using this.
Cool. Yeah, that makes sense.
A little bit of a long-winded answer, but yeah, that's my opinion. Is I don't necessarily think that we're ready to do it tomorrow. Instead, I actually think that we have a lot of steps to get there.
Yeah, it's like we were talking about the reporting before. I heard you say kind of ratings, safety, regulation, compliance, like just working inside a regulated industry, even if all the laws are there already, still takes a bunch of trusted reports. I mean, money moves at the speed of trust, right?
Yeah, it's a great way to put it. Better Money Company, you guys should use that slogan. And you should give Nathan some kickback on using it. But I think that's a really good point.
To be clear, I did not invent that phrase, I don't think.
It doesn't matter. I'm giving you the credit for it.
All right, I'm taking the kickback now that I've cleared it out.
Nice. No, but I think that's like a really important point, right? Is you can build all of the infrastructure and you can build all of the technology for us to be able to do clearing in a scalable way and everything else. But if people don't trust the technology that we're using and people don't trust the technology that it's being built and shipped, it doesn't matter, right? And it's not going to get to a point where people are actually willing to use it.
Totally. Cool. Well, as we're kind of winding down, getting past some of the main topics we talked about, there's a few things I do always like asking folks. So one of those questions, I think I shared this with you before, so you might be prepared. We'll find out.
That assumes that I did any preparation work for this phone call, and I wasn't just like, yeah, let's get on a pod and talk about things.
All right. You will not be prepared for this question. I will rephrase. Who are some of the thought leaders that you like to follow around stablecoin infrastructure, around tokenization, around clearing? Who are the people that other listeners should be like, okay, Henry's done the hard work. He's thought about this for a long time and I can learn from the people who he's now found?
Man, I actually don't know if I'm prepared to answer this question, but I think that you can look at the best way to look at this is actually, I think, despite what my comment was earlier, go to the VCs that you think are funding the most interesting deals and look at what they're saying, right? So I think Mark Andreessen's obviously a very good point there, and the folks at A16Z, I think Guy is great, one of the investment partners there, and somebody who I continuously follow and what he's doing, what he's interested in. But I also think that the smaller funds are even more interesting, right? So go to Mike Dudas and look at what he's funding, go to a DCF and look at what they're funding, go to a Strobe and look at what they're funding. And I think all of those folks are just off the top of my head, people who I look up to in the space, right? And I think if you're not somebody who's looking up to other people in the space that are doing interesting things, you're probably not ambitious enough, and you're probably a little bit too egotistical is maybe the best word to put it. But I think that there's a lot of folks that are funding interesting things, and typically their theses are things that are not proven out yet, and those are the best ways to look at it because they've done a lot of the hard work to try to formulate a thesis around it, and typically VCs have the best hot takes if they're a small VC that's trying to be scrappy with a small amount of money.
Cool. Yeah, those are good people to follow. I'd endorse some of those for sure. Okay, that was people to follow. And then is there anything else that you want to talk about we didn't hit? Is there anything else that you're like, man, I really do have this thing I wanted to say, but Nathan sucks at asking questions, and so we didn't get to it?
No, you've been great at asking questions, and I always applaud podcast hosts because they're asking the hard questions and doing all of the due diligence and groundwork for it. I think one thing that's interesting to talk about is kind of back to the last question actually around who are the right people to follow in the space, who's doing interesting things. If you're a founder and you're listening to this and you either already have an idea and are working on it, or you are trying to figure out what to build and you just have the founder energy and the founder grit, I wouldn't just look at who's getting the most funding. I wouldn't just look at who is building the hottest thing that's having all the marketing announcements. Instead, I would look at those folks who are already winning and say, how can I help them win even more? And I think that those compounding effects is how we go from building a lot of the same infrastructure, back to my hot take around payments or protocols or whatever it might be, to actually having implementations of new technology that I can explain to my grandmother, or I can explain to a child of, hey, this is like an interesting thing and an interesting application for you to go use. And they might not ask the question of, oh, is this a blockchain company, or, oh, what is this other thing? Instead, they're just saying, okay, all of the infrastructure already exists in the back end for this, and now I have a new experience that I can do. So think about things outside of the bounds of what most people are thinking about it, and instead think about it as, what can I use the infrastructure that's being built today in order to enable new experiences?
That's a really interesting answer. You started that and I was like, okay, he's going to go talk about like people doing more unpopular things. But then you said instead follow people who are winning and do extend it, which is like a very different lane. So that's kind of a cool, I love it when someone answers it differently than I expect.
Yeah, I think I appreciate that. But I think it's to your point, like winners, average winners, kind of like what you were saying earlier in terms of where VC funding is going or where founders are focused. The best way to continue to average winners is to compound those effects, right? So think about it as the fintech companies that already created the rails, and now people are focused on building a new payments company or a new card or whatever it might be. Actually, here's a really good example of this. Robinhood, right? They built obviously what is one of the most successful brokerage platforms. Now they're getting more into the on-chain space, but they did that by already having all the infrastructure in place for a brokerage account to actually be run. And then they were just subsidizing the fees, right? And that's how they got to a zero fee environment. And that's how they actually changed the industry that allowed more people to focus on trading and owning their own destiny from an investment perspective is maybe the best way to put it. And now all these fees have compressed on the brokerage accounts, and almost all the transaction fees are now zero because Robinhood started off and used all the infrastructure that existed already. And I think that's a really good way for people to think about it from a digital assets perspective is how do we create the next Robinhood that's built on top of a brokerage infrastructure, but instead, how do we build the next Robinhood that's focused on something else that's already built on the payments infrastructure or built on the protocol layer that exists?
Love it. Yeah, those are not areas I've thought a lot about, so it gives me something to think about too.
It's all of these responses are not polished, so if anything's long tail for the listeners and extended or not clear, I apologize, and you are always welcome to reach out and ask questions or tell me why I'm wrong about something. I enjoy being wrong.
Yeah, that's amazing. I mean, obviously we need to pay you more so you polish for these podcasts.
No, come on. Then I wouldn't have as good of hot takes.
That's right. Okay. I'm trying to wrap down here. Other fun last question I like to ask people, and again, you may not have an answer. We can go on from this. Is any outside of work, outside of kind of everything we've been talking about, any content that you've really been enjoying? Books, movies, TV, anything like that?
I love some good brain rot TV and some good shows. So I've watched every new episode of House of Dragons, every new Game of Thrones
Ooh.
spinoff. I think actually to that point, when I was a founder, I was really focused on the fact that I always needed to be on and I always needed to focus on building something. And sometimes just turning your brain off and enjoying somebody else that's being creative in their own lane is the best way to be creative in your lane. So that's something that I had to learn the hard way of not burning myself out, but I think is important. So yeah, I mean, content wise, like I love good TV. So House of Dragons is great. All the Apple TV shows that come out are great. Big reader. I really enjoyed all of the. I'm trying to. Oh man, what's the book name? It just was very popular. Oh, Red Rising. I really enjoyed
Oh
that
yeah,
entire series. That
yeah,
was
that was good.
amazing. I read almost the entire series in like 10 days. I just couldn't put it down. So if you haven't read Red Rising, it's a great series to go read. If you haven't watched House of Dragons or Game of Thrones, go watch those. And then outside of that, it's just brain rot on Twitter, honestly.
Fair enough. But yeah, I mean, it's pretty cool. Like in 2026, we're like talking about like AI and all this blockchain, all this fancy technology, quantum, and like you can still have a page turner. Like, it's not only TV that's as gauging. Isn't that's kind of cool. I like that that's still true today.
I totally agree with you. And Red Rising is probably the best example of that, in my opinion. If you haven't read it, stop. I mean, all the VCs are going to hate me for this, all the founders are going to hate me for this, but like, stop doing whatever you're doing. Just go read the book. It's so good. It is so good.
Hot take, founders. Stop building and start reading. All right, that's what we're ending on here, I
That's a
think.
great way to wrap it up.
Well, Henry, thank you so much for your time. I really appreciate you coming on the show, and good luck with all of the brain rot.
Thanks, man. I appreciate it. And thanks for having me. It was great. I'm excited for the next iteration of this.
Thank you.
See ya.